Coming up on the SBS On The Money podcast, a recession warning, failed peace talks impacts the market, and can AI interpret geopolitical risk? All of that and more next. Hi everyone, welcome to the SBS On The Money podcast for this Monday, the 13th of April 2026. It's a day where the Australian share market fell 0.4%. We'll have the details with Armina Rosenberg from Minotaur Capital in a few moments. She's an AI-driven investment manager who'll tell us whether AI can interpret geopolitical risk. Now, if you're new to the podcast, welcome. We go into more detail of the top consumer finance and market news stories that we cover during On The Money on SBS World News, including a warning from economic forecasters at Deloitte Access Economics that Australia could be at the doorstep of a recession, even if the war in the Middle East ends soon. It's not the company's base case scenario. Their modelling reveals either way, though, inflation will stay higher for longer as a result. Over the weekend, oil prices jumped back above $100 as peace talks collapsed. They're at around 102 US at the ASX market close. If the war winds down by June, Deloitte says Brent crude will still rise to 120 US and stay there until the end of the year, meaning inflation will hit 5.5% by then and edge the economy closer to negative growth. Its main assumption, though, along with the broader market, is a de-escalation in a few weeks. And while that will likely see oil prices ease, inflation will still remain high at around 4.5%. The volatile environment may mean the government will go down to the wire when finalising its May budget as it balances competing priorities. And for more, I spoke with Deloitte Access Economics partner, David Rumbens. So, David, even a near-term wind down of the conflict would have Australia at the doorstep of a recession. That's what Deloitte's saying. Why? And what would that look like?
So, against our baseline forecast, we've considered some alternate paths for the oil price. If the oil price moves up to $120 US over the coming months and stays there through the year, that's troublesome for Australia. That's a significant hit to the cost of living for consumers. What it looks like is the CPI peaking at about 5.5%, consumers being hit by high petrol prices, and also the indirect effects of higher costs through the supply chain, cutting into consumer income. There's also effects on business as well. So this is a scenario where business investment reduces, unemployment starts to go up, and we have very little economic growth. We have GDP growth of 0.7% at the end of the year in this scenario. And that's basically through the June, September and December quarters, basically no growth through that time.
What's interesting in the scenarios that you've presented or Deloitte's presented is that even if we do see a winding down of the conflict in June as a near case scenario, your base case scenario still has that oil price at an elevated level when compared to pre-war times. I think pre-war we were around about 70 US. So the effects of the war either way will be long lasting, right?
Absolutely, yeah. Our base case has the oil price still in the 80s but by December, and the alternate scenarios that we've considered have it higher, up to 120 or more. And the truth is we don't know how long it will take for energy markets to recover once the conflict does start to wind down. We know there's been a lot of damage to oil and gas production facilities, a lot of damage to infrastructure. We don't quite know the mechanisms as to how these things get in order. So it is prudent to consider a case where it takes some time for oil prices to come back down.
Even if it does lead to higher inflation, these higher oil and petrol prices, and ultimately these, secondary increases to prices as a result, could they not act as an pseudo interest rate rise from the Reserve Bank anyway, and we may not need to see as many rate rises as some people had been expecting?
Look, they will be taking demand out of the economy essentially. So they will be a cost of living hit to consumers and subduing the economy. The Reserve Bank is still focused on achieving price stability. So, these are also inflationary effects. Now, the Reserve Bank is clued on to temporary factors. So to the extent that they think this is a temporary hit, they will take that into account. But the longer that oil prices remain high, and the more that it feeds into inflation expectations, the more the Reserve Bank will think, well, actually, this is a more permanent hit, and so we have to take it more seriously as an inflation shock. Although at some point, the Reserve Bank is also going to pause and say, well, we've delivered 2 rate rises now. If they go again in May, that will have delivered 3. That might be the moment that they say, well, let's also have a look at how much damage we're doing to the real economy through those rate rises, as well as you said, the high oil prices.
And finally, from my understanding, your forecasts don't include government action. We're about to head into the federal budget next month. What do you think it'll be for? What it'll mean for the budget creation and government policy? Do you think the government, for example, will wait until the last minute to finalise things because we've got these changes happening every day, and they'll need to remain nimble?
Yeah, I think they've indicated they will run it to the wire, but there's a couple of competing priorities, or perhaps several, but they include the need to get the budgets, the fiscal position under control. So move back from a structural deficit that we've got at the moment. And the Treasurer has been talking about having savings measures in the budget. So there is that fiscal task, or that reform task to undertake. But at the same time, there is the fuel crunch to consider. So that's, what can the government do to help shore up supplies and to provide temporary targeted relief to those consumers and businesses that might be most hit in the meantime, noting that, they should be looking for some offsets in other areas for the relief that they provide. So I think they'll be looking at that balance. They most likely will be taking it down to the last moment to see what the global environment looks like.
David Rumbens there from Deloitte Access Economics. Let's go to the Australian share market now, where the S&P ASX 200 fell 0.4% to 8,926. That's as oil prices surged. Brent crude up 7% to around 101 US as Middle East peace talks broke down at the weekend and Donald Trump ordered a blockade of the Strait of Hormuz. Energy stocks did well as a result. The likes of Woodside up 2.6%. The technology sector was the worst performing on the index. In company news, Monash IVF rallied 16% on a takeover approach, and A2 Milk tumbled 13% following a profit downgrade. Despite the market's fall today, the ASX 200 is still 3% off of its record high. For more, including whether AI can interpret geopolitical risk, I spoke with Armina Rosenberg from Minotaur Capital. Amina, so it's obviously a very volatile time for investors at the moment, hanging on every move in the Middle East. What do you make of the way markets are trading at the moment? Because even though we're seeing all this uncertainty, we're only a few percentage points below record levels anyway.
Yeah, it's a really interesting dynamic. On the surface, it looks strange that markets are only a few percentage points off their highs, as you said, especially given the headlines. But beneath the surface, there's been a massive rotation and dispersion. So energy is up nearly 30% this year, but the broader market is roughly flat. So what that is telling you is that the index level numbers are masking a lot of internal disruption. I feel like the market's repricing risk, but not yet at panic levels. So capital is rotating out of duration sensitive assets like growth tech, gold miners, anything that gets hurt by higher real yield, and into energy and shorter duration cash generative businesses. And I think the reason we haven't seen a broader crash is that the underlying economy, particularly in the US, has been pretty resilient, and the AI investment cycle is still providing a genuine earnings tailwind for a large portion of the index. So you've sort of got these two forces pulling in opposite directions: geopolitics pushing yields and oil higher, and corporate earnings and AI capex providing a floor. So for investors, the message is that the index can be deceptively calm, but there's a storm underneath, and basically you have to pay attention and be willing to move.
I want to go into detail about AI in a few moments, but first, oil. It surged back above $100 a barrel over the weekend amid those tensions in the Strait of Hormuz. How should investors think about energy shocks feeding into inflation and interest rate expectations?
Yes, that's the key transmission mechanism. So oil above $100 feeds directly into headline inflation, which constrains central banks. And we're already seeing this play out. So the Iran-driven oil spike in March pushed up real yields, strengthened the US dollar, and that had a cascading effect, which hit almost everything. So growth stocks, gold miners, even European defense names all sold off. And the sell-off was pretty indiscriminate. And I think what March taught us is that macro shocks like this can temporarily overwhelm diversification by moving everything together. But those correlations don't typically last and they can create some real interesting opportunities. So I think for investors, the practical takeaway is twofold. First, higher oil for longer is a rate headwind. It delays rate cuts and complicates the soft landing narrative. So you want to favor companies with real cash generation over those relying on multiple expansion to drive share prices. And then secondly, in a world driven by unpredictable geopolitical shocks, diversification remains the single most cost-effective form of risk management available. So we've responded by exiting positions where we've lost conviction, shifting towards more stable quality names with earnings and cash flow support. And we've selectively added energy exposure where the barrels don't transit through the Strait of Hormuz. But the broader lesson, I think, is to stay diversified and stay active.
Now, for our audience that doesn't really understand or heard much about Minotaur Capital, you use an AI-driven investment approach. How does AI interpret geopolitical risk?
That's a great question because I think there's a misconception that using AI to help investing means handing the keys over to a black box or that we run what's called a quantitative or systematic fund. That's actually not what we do at Minotaur. So we use AI to accelerate human decision making, not replace it in a fundamental bottom-up strategy. When the Iran conflict began, for example, we used our software system Torian to help us research the implications and where there might be opportunities and where we could be at risk. But to be clear, AI doesn't predict geopolitical outcomes. No one can do that. What it did is help us map the implications faster and more thoroughly than a traditional process. It helped us take a messy narrative and force it into a structured investment decision. So AI helped us basically do the mechanical work faster, but the judgment still sits with us. It interprets geopolitical risk less as a prophecy and more comes up with a bunch of scenarios. So Torian's Iran report actually had 5 scenarios in it. It wasn't just like what happens if there's a war. It modeled 5 distinct escalation paths, tried to ascertain probabilities, and then mapped each one to portfolio implications for each of our stocks. And then it also helped us with the second and third order effects that humans can often miss in the fog of a crisis. So, for example, our system identified that Mitsubishi Motors, which we're already short, was going to benefit on both sides. So it was going to see higher fuel costs and an accelerating EV transition narrative. And that was actually right. So it was a big contributor in March for us. So basically where AI adds genuine value with regards to geopolitics is speed and breadth. You know, a traditional analyst team might cover like 5 stocks each. We have 1 agent per position and the ability to spin up deep dive research on new opportunities within minutes and hours, not weeks. So that's probably the key difference.
This is Armina Rosenberg from Minotaur Capital. We've seen another sell-off in AI-related software shares, particularly in the US. We saw Atlassian being removed from the NASDAQ 100 index. What's your take on the sector? Is the sell-off overblown? And what's your overall take on AI and the implication for investors?
My take is that the sell-off has been directionally justified, but too blunt. And it's something we've been close to because it's been one of the most significant rotations in our own portfolio over the past few months. We actually owned Atlassian until January when we sold it and moved our entire software position from being net long software to net short. So in a sense, we saw this coming, but the speed and severity has been swifter and deeper than we ever thought it would be. So for over a decade, it makes sense because for over a decade, SaaS was considered the highest quality business model in the market. You know, recurring revenues, low churn, pricing power, and terminal values that were bankable into perpetuity. But AI is now fundamentally challenging that narrative. And the question the market is grappling with isn't whether AI will be transformative, but who captures that value. If AI means that new competitors can build software faster and cheaper, or that per seat pricing models erode as teams shrink, or if switching costs fall, then the terminal values that justify those high multiples need to come down. But the market at the moment is applying an AI loser label to pretty much everything across the whole sector. And I think that is creating opportunities. So if you take GitLab, for instance, that's a stock that we own. Basically, AI coding agents are actually generating more code, not less. But that means enterprise review backlogs, security issues, and pipeline failures are rising in that complexity. And GitLab is building the governance layer that lets enterprises safely ship what AI agents produce. So more AI code means more need for GitLab, not less. Now that position hasn't worked for us yet because of this indiscriminate sell-off, but I think that's one where people will go, actually, that's an AI winner. So to directly answer your question, parts of the sell-off have been overblown and parts have been completely justified. And the skill right now is in telling the difference, but it does feel like the market seems to be putting all software in the too hard basket, and it's hard to see the catalyst for software starting to regain momentum.
And Armina, just wrapping up, what are you telling your clients right now, and what are some of the other opportunities that you're seeing?
Yeah, what we're telling clients right now is stay invested, stay diversified, and be deliberately active. The dispersion we're seeing with energy up 30% and software down 40% in places means that the opportunities are enormous, but so are the risks of being in the wrong names. And, I keep talking about diversification, but it is the easiest way to manage risk, particularly in a market being driven by macro and geopolitical shocks that are really hard to predict. Like nobody predicted the timing or the severity of the Iran conflict. So rather than making one big macro bet, we think investors are better served spreading their risk across multiple independent return streams, across different geographies, across different sectors, across different themes, so that no single outcome can sink you. In terms of where we're seeing opportunities, we like memory semiconductors. So they had a tough month last month going through their own sort of deep seek type moment with a paper being released by Google, which showed that turbo quant means we need less memory for the same inference cost. But lower inference costs has actually historically increased total usage, not reduced it. So we do think there's a good opportunity there in names like Micron and SK Hynix. European defense, you would think that they would do well in a geopolitical turmoil like we've seen, but those stocks actually corrected 15 to 25% last month, despite NATO spending growing 20% in real terms last year. So we think the structural driver is still there and not being priced in. And then from the Iran conflict, we think Chinese EV names look really interesting. I was in Shenzhen last week, and some EV companies I met with mentioned how they've seen an acceleration in demand as a result of the conflict, and that specifically in Australia, wait times have blown out from 1 to 2 months to 1 to 2 years. I thought it was an interesting data point. And then there's a whole bunch of idiosyncratic ideas, and that's where, our AI system really earns its keep. So we scan 35,000 articles a week across multiple languages, looking for structural strategy changes. And these are individual stories the broader market hasn't fully appreciated. And because they have company-specific catalysts rather than macro, they add genuine diversification to the portfolio. So I guess, overall, the key message is diversify, stay active, and let the volatility work for you, not against you, and don't be afraid of it.
That's Armina Rosenberg there from Minotaur Capital, and she wraps up the podcast for this Monday. Give it a like, a review, and subscribe if you enjoy it. And don't forget, you can watch On the Money during the 6:30 weekday edition of SBS World News on SBS. The podcast returns tomorrow. It drops after the market close every weekday, and I'll catch you then. This SBS On the Money podcast is provided for informational purposes only and should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.